So yeah, today we're going to be talking about Augur protocol. It's basically a decentralized oracle and decentralized prediction market platform. Their V2 is like coming out next month, so a lot of new traffic. Like it kind of fell off over the past couple of years, but V2 is drumming up like a lot of interest in their token and then also in the protocol itself too. So yeah, without further ado, let's dive right in. So yeah, hosted by high quality. So if y'all have questions, just feel free to type them in the chat. Let me figure out how to, I'll just pull it up like pretty much whenever I want to answer questions. So yeah, let's go for it. Yeah, so we'll be first walking through just a general overview of the paper, some context for what the paper is based in, why it was created, etc. Then we're going to be walking through a high-level overview of the paper, explaining the general concepts, going through what exactly is necessary in order for them to build the decentralized oracle, as well as how they were able to establish a decentralized prediction market platform. We'll be walking through the paper then in more depth, and then finally we'll be wrapping up, and you guys can ask questions at any point throughout the presentation. So if you guys like feel stuck or anything, just type your questions in the chat, or whenever I'm done with like a section or like I pause, like I ask. So yeah, let's go for it. So the entire reason why Augur was created is to really shift away from traditional betting markets. There's a lot of centralization. This is what we see a lot in the DeFi space as well as in a lot of major platforms that are based on like Ethereum, is the fact that you really want to take away the necessity of having a trusted operator of the market to ensure that the markets are resolved correctly. And by removing this need to have like a central operator, you remove the possibility of corruption and theft within prediction markets. Additionally, within traditional prediction markets, the market operators decide how the outcomes are resolved. So say like you have like Schrodinger's cat, right? In Augur, right? The users on the platform to be able to decide whether or not the cat was dead or alive, whereas the market operator in a traditional centralized betting market would be able to decide whether the cat is dead or alive, and that wouldn't fall on the bettors. So it's unfair towards those who are participating in the platform, and it makes it more competitive, enables more kinds of markets, and enables people to participate in prediction markets at a lower cost. So a lot of incentive for this platform to be created, and we're really seeing a lot of growth in terms of how exactly the platform is being used by people. So we'll now be diving into some background and context for the Augur platform. So the current status of betting markets and decentralized oracles is pretty significant within the space. We see Chainlink as really the establishment of a key decentralized oracle within the space, but Augur takes a different methodology for handling decentralized oracles. It's completely crowdsourcing the information. They're asking people, where exactly are you getting this information from? Say, I say that the Patriots are going to win the Super Bowl, like versus the Rams or whatever. With Augur, it'd be completely crowdsourced by reporters reporting on that information off the internet, off of reliable sources. And so it enables a completely decentralized oracle that's entirely reliant on the peer-to-peer users. And this is all held in-house on the platform, but it's also accessible to other platforms as well. And that's an issue that I'll dive into later. So in traditional markets, what we see is a centralized set of entities who are determining the outcomes of the prediction markets. The outcomes aren't resolved by the users on the platform. Instead, they're resolved by these central entities. Additionally, the ledger is also responsible for distributing the payouts to traders. And so there's a lot of secrecy behind how those outcomes are distributed, as well as a significant amount of fees are taken away from bettors by the operation of that central betting authority. And so this makes the market more fair. Additionally, participation in betting markets and prediction markets is difficult and is limited. And as well as the creation of new markets is also limited in traditional betting markets. And Augur opens up people to essentially create whatever market they want to, and it limits and lowers the barrier to entry for participating in these prediction markets. So yeah, wait, I'm just trying to see how I can pull up questions in the chat at the same time. One sec. So, yeah, here we go. So, yeah, now we're going to be diving into some just general factoids about the prediction markets in general. So, prediction markets generally fall under the purview of the Commodity Futures Trading Commission. And due to Augur's decentralization, it falls outside of the scope of this regulation. And so it's really enabling a more free and market fair prediction market, as the onus for the risk falls on the majority side on the users of the platform. And so it enables a more market effective way to handle prediction markets. And so we really see Augur as a way to expand prediction markets into a globalized, open, and fair platform for users. And this is really accomplished, and this is their main innovation through their decentralized Oracle and reporting aspect of their platform. So basically, we're now going to be going over a general high-level overview of the platform. So exactly the stages the platform does to handle itself as a prediction market, as well as some general understanding of how exactly the platform handles its Oracle. And if you guys have any questions, feel free to drop them in the chat. Okay. So there's 4 main stages and components in the Augur prediction market platform: market creation, trading, reporting, and market settlement. So users on the platform, market creators, can create a market about any upcoming event, and the bonds, they have to post bonds that are required to, say, create the event onto Ethereum. And after doing so, trading begins. So participants, otherwise known as bettors, forecast the outcomes of events by trading shares of the outcomes. And there's an order book that fulfills the request to buy and sell shares. It essentially works as a traditional order book on a DeFi platform, and it enables decentralization of the trades. The largest part and most significant part of the Augur prediction market platform comes in the reporting stage. So this is when, once an event occurs, the outcome is determined by Augur's Oracle. And this is really where Augur takes a step away from traditional prediction markets and steps into how exactly they can use a decentralized Oracle, the reporters, to determine the event's real world outcome. The last stage is market settlement, and this is when traders close their positions and sell shares to other traders or settle with the market contract. Yeah, so with previous markets, so Andrew asked, the previous issue with prediction markets is that they were riggable, and the fact that there's some like ambiguous cases. So I'll explain this later, but basically like an example of this happening is like there was a betting market, like some centralized trading platform had a bet on like whether or not North Korea would launch a ballistic missile. And so they had said that it needs to be reported by the DoD in order for it to be validated. But they didn't include that in like the central part of when people were betting. So the bet was, will North Korea launch a ballistic missile by like June 1st, 2016? And they did end up launching it. But then because of the fact that the Oracle, or the centralized authority, not the Oracle, had the ability to say, hey, the DoD didn't report it, therefore we don't have to pay out to those people who said that they were going to launch a ballistic missile, demonstrates the fact that it is a centralized source. And on Augur, what would happen instead is that the users on the platform would determine whether or not that's the outcome that they truly believed in. And so that's the advantage of the Augur platform, is that it puts the onus on the reporters, on the users of the platform, to determine the real world outcome. So in the vast majority of cases, that's just going to be reporting, oh, this happened. But in cases where it is ambiguous, there is an ability to resolve the market as invalid, or also resolve the market in a way that's actually effective to what the users want, which is what a prediction market should be. So yeah, we'll now move into key terms and assumptions. So a significant part of this is that there are 3 kinds of users on the platform. There's market creators, which I touched on earlier, traders on the market, which are considered bettors, and reporters, which take the place of a traditional centralized validation of an outcome. So these traders are people who are staking rep, which is reputation. It's the native token, and it's how Augur's Oracle determines what the actual outcome is. So reporters stake rep on outcomes to get that outcome to be the outcome that's determined by the oracle. And once consensus is achieved on a specific outcome, that becomes the finalized outcome. So the entire point of Augur is to decentralize that oracle system and enable the markets to achieve the true outcomes, which are the real outcomes, instead of the false outcomes, which are the opposite outcomes of what actually occurs in the real world. So, yeah. So I'll touch on a little bit later about how Augur secures against reporters being the same as bettors, but essentially, yeah, I'll go into a proof on how exactly that happens later on. So, yeah. So the main motivations are, again, the high cost of arbitration in traditional markets, the fact that self-interest in traditional prediction markets can turn into corruption and theft, and the fact that there needs to be there should not be the need to rely on a trusted intermediary when you can have a decentralized oracle, the reporters who determine what the actual real world outcome is. And with Augur, you're able to also reduce and lower the trust required in the market, the fees in the market, as well as friction within the market as well. So basically by reporters staking rep and staking real world outcomes, it drives towards market efficiency and ensuring, and Augur's platform ensures that the oracle process will report truthfully and ensures that within these prediction markets, the outcome is being resolved in a peer-to-peer process, which involves all users. So, yeah. The key design goals of Augur are focusing on security and access. So the first thing that they want to ensure is that an attacker can't take control of the platform, because if people are able to shift the outcome towards an outcome that's not the actual real world outcome, then that destroys the integrity of the platform. And this is accomplished through the forking process, which I'll dive into later. And though this process, you will soon learn, is in fact very arduous, it ensures that the oracle is valid in all cases and really is resilient towards attacks from attackers. So a general overview for the Whitepaper deep dive is going to be looking at the market creation, then diving into the trading, then diving into the reporting and settlement. That's all in phase 1. That's all in section 1 of the paper. Then we'll be diving into the incentives and security of the paper, then some potential issues and risks, and then we'll be wrapping up with a quick conclusion. And then at the end, you guys will again have the opportunity to ask any questions that you guys have. So without further ado, we'll be jumping right into the actual paper. So yeah. So the Augur market moves through 4 stages in the life cycle. So there's market creation, trading, and then the market event actually happens. And then reporting on the market occurs, and then settlement on the market occurs. And these all occur within fee windows, which are 1-week timelines. So whenever users create a market, they have to set like an end date for the platform. And then once that end date is hit, that's when the reporting for the process starts. So whenever market creators create a platform, they set the event end time as well as a designated reporter to report the outcome. So market creators set a resolution source. So say that I was betting on like what the weather is going to be tomorrow. Like I said, oh, it's going to be hotter than 75 degrees tomorrow. Then I link like weather.com or NOAA as the source for whether or not that information is actually true. So like the weather is going to be over 75 degrees in Washington, D.C. And this is the source that would be effective for the reporters to use. Reporters have the ability to use other sources. This simply simplifies the process and streamlines the process for reporters to report the outcomes. Additionally, when market creators are creating the platform, they set a creator fee and they post the validity bond and the creator bond. The validity bond incentivizes market creators to create markets with clear outcomes. So stuff that wouldn't be as clear, like is Nishan's cake good? That wouldn't be as valid of a prediction market to create. And the validity bond ensures that market creators are creating prediction markets that actually have very clear defined outcomes. Because on Augur, people have the ability to create any prediction platform, so it's necessary to mitigate ambiguous prediction markets on the platform. the creator bond is returned to the market if the market resolves to the designated reporter. So the designated reporter is someone that's trusted by the system to report the process quickly. Their outcome that they report can be disputed. It just simplifies the process for traditional prediction markets. And this designated reporter is picked by the market creator as someone who can be trusted by the community to report quickly on the true designated reporter, on the true outcome of the event. So the validity bond, the creator bond essentially are incentivizing a simplification and streamlining of the prediction market process, but there are checks and balances in place to ensure that if these fail-safes do fail, there are ways to mitigate the impact on the platform and on the protocol. So after the market has been created, it now moves into the trading phase. So this is where market participants are forecasting the outcomes of events by trading shares of the market outcomes. And what we see during this trading phase is that it's what you see in traditional betting markets as well, that the shares of the outcomes are accurate predictions of what people believe will be the outcome of, say, like the fight. So say like in Pacquiao versus Mayweather, a lot of people favored Mayweather. And so that could also be seen through the market outcomes because more money is being placed on Mayweather winning, and that's how the odds shift. And we see a similar occurrence on the Augur platform as well. Whenever there's betting on a market, if it's shifting towards one side, betting on one side will net you less gains than on the other side. So say like you were betting on a heavy underdog, you'd be gaining more out of it than were you betting on someone who was not an underdog. And this is basically mimicking a traditional betting platform. And trading sequesters the amount of, using the order book, enables traders to sequester the amount of risk that they have. And this is accomplished through a completely decentralized smart contract system that removes the need for like a centralized ledger to handle those trades and the secrecy behind those trades. It also cuts down on the fees, as the only fees are mainly within the reporting piece for the platform, as well as the gas fees that are necessary to post your trades. So, yeah. Yeah, so now we're moving into reporting. So as you can see here, reporting is a tad bit more complicated than the other aspects of the market platform. So if you look on the right, there's a general overview and flowchart for how the reporting and dispute process works. So once the event ends, the outcome needs to be determined by the market. And then the Oracle goes through this reporting system with reporters in the market having reputation token to be able to stake on what they believe the objective reality is, or what the actual objective reality is, and they're financially incentivized to do so. So I'll be walking through in the reporting process, as well as later on how exactly the reporting process ensures that the actual outcome that's being determined is in fact the true outcome, and negative outcomes are disincentivized on the system. So yeah. So there's three major reporting rounds. We have designated reporting, we have open reporting, and we have the dispute round. So designated reporting is the kind of reporting that I touched on earlier, where the designated reporter has 24 hours after the event's end date to report on the outcome of the event and receive the creator bond. So the designated reporter is deeply incentivized to report correctly and early on the actual outcome of the event, as they will receive monetary compensation for doing so. However, if they do report incorrectly, this can be disputed in the dispute round, which draws in all the reporters on the platform to dispute something that they believe is incorrect on the platform. So say in the Mayweather-Pacquiao fight, if someone said that if the designated reporter said that Pacquiao won, people would be able to dispute, and other reporters would be able to dispute that Mayweather had actually been the one who won the fight in the dispute round. So say that the designated reporter doesn't report on the platform. Say they've gone inactive, maybe they've gone on a trip to Hawaii. In the open reporting platform, they'd be able to report on the outcome of the market. Anyone would be able to do that. And so it essentially enables it ensures that the outcome of the event will be reported as quickly as possible. And this is ensured by making it so that anyone who's reporting during the open reporting phase doesn't actually have to stake their rep on the outcome. And so it ensures that the market resolves quickly and is able to move into the dispute round quickly. So the first public reporter to report on the outcome receives the forfeited bond, and then the outcome becomes tentative. Now, if the tentative outcome, either from the designated reporting stage or the open reporting stage, is disputed, then the Augur reporting side of the Augur platform moves into the dispute round. So any holder of the reputation token can challenge the tentative outcome. So this ensures that if anyone has a challenge against it, they're able to voice that out there. But people are disincentivized to challenge outcomes that are seen as real world outcomes, ones that they'll fail, as reputation holds a real world value. So it'd be essentially burning money on the platform. So yeah, we'll now be diving into how exactly the reporting works, as well as the dispute round specifically, as this is we really see the innovation of the Augur platform. Let me check if there are any questions. Yeah. So in the dispute round, we see that any reporter can stake reputation on any outcome. And this is where we see the reward for dispute reporters, as they're incentivized to report on incorrect outcomes, as they're given a reward for doing so. So this formula we see on the right is the guaranteed return on investment for those who dispute correctly. So say in the Mayweather-Pacquiao fight, those who dispute the Pacquiao outcome would gain a fixed ROI, ensuring that all reporters are incentivized to dispute incorrect outcomes. So whenever we go into the dispute round state, there are three kinds of outcomes that can result from it. So in the first outcome, this is where we see the forking protocol invoked. And this is when over 2.5% of all reputation in circulation is staked on the platform. So this really caters itself towards a large event. Say that a lot of people were fighting over an ambiguous sort of event. This would drive it towards the fork state. And this is really, we really see the integrity of the Augur platform come out. Say that only 0.02% to 2.5% of the fees were staked within the dispute round. Then we see it enter the next dispute fee window, which is the next week, and then the dispute round would be repeated, and then honest participants then are given time to refute a false tentative outcome. So they're able to post the bond. So say like someone with a 1% stake on the platform is disputing the round, even though they know it's incorrectly, even though they know that the outcome is correct. This gives time for the honest participants to dispute the dispute on the correct outcome, and ensure that the market resolves to the true outcome, which is the real world outcome of the event. And if we have less than 0.2% of the reputation staked, then what we see is just the dispute round continues until it's resolved. And so this really enables levels of assurance that, say, enough users on the platform were concerned about the staking within this stage, within the dispute stage, then we see that we move again into a dispute round to ensure that the outcome is actually the real world outcome. Yeah, so I'll touch on this a little bit later, Andrew, but Andrew asked, while adoption is still low on Augur, is there a worry that the fork state will be triggered too easily? And this definitely is true right now. I think Augur has only around like 100 daily traders, which is very low, but it's very easy to see how reputation could be staked. But essentially what happens is that whenever the market enters a forking state, all betting is closed down. So what we see is that until the fork is resolved, there's like a 60-day period where the fork must be resolved on the platform. It's the integrity of the platform that resides on that, because as soon as an attacker is able to take control of one event, they're able to take control of all events, and then the integrity of the platform falls. And so triggering forking is heavily disincentivized, except in cases where we see a false real world outcome being reported, and then enough honest reporters on the platform are triggering this reputation outcome. Yeah, so Robert asked if there's a mechanism to prevent a lot of, Robert asked if there's a mechanism to prevent a lot of markets from being created for the same event. So if you're creating an event, you have to post a bond, and that's essentially escrowing money. So people are not incentivized to create markets when the adoption of their market won't be that high. So say like there's like 100 markets for Mayweather versus Pacquiao. People will only bet on the first one to come out. they're not going to bet on the 100th one because there's already a market that exists. There's more reporting fees there. There's more trading there, so your orders are more likely to get fulfilled. And so as a result, people are driven towards that singular market. So Andrew asked a follow-up. So if betting is shut down during a fork, couldn't it attack or bribe? Couldn't you bribe people into disputing and forcing a fork? So what we see happening is that if you do that and the market resolves quickly, so say like you dispute a correct outcome and the market resolves quickly, well, now you've just burned 3% of all reputation on the platform, as when you dispute incorrectly, you lose all of the reputation that you staked. And so people aren't incentivized. So let me take a real world example. So you could file a lawsuit about something that, like anything you want to, but if you know you're going to lose, and yet you're still paying, say, like $1,000 an hour to your lawyers, is it worth the time and the money to force that fork knowing that you're going to lose that money? Or is it better to invest in something that actually accomplishes that? And so assuming that people act economically rational, what we see is that people will not be forcing forks unless there's actually a dispute round to force that. Obviously, if you run into an economically irrational actor, that's where issues come up, and that's something that I'll touch on a little bit later on when I dive a little bit deeper into the forking protocol. So yeah, let me move into the next section. So yeah, so now we'll be diving directly into forks. So basically how forks work is that for every single outcome, there's a new child universe that's created. And there's really a distinction here to be made between traditional blockchain forks, say like on Bitcoin, versus what we see on Augur. When you stake on Augur, you're migrating all of your tokens to a specific child universe. So if you know that an outcome is true, right? We'll again take the Mayweather-Pacquiao example, and you migrate everything to Pacquiao instead of Mayweather. When the market resolves, you lose all of your reputation tokens. So both don't exist. There's only one fork that exists once the market is resolved, and everything else is burned. On the market that it resolves to, people are given like a 40% ROI on their investment in their staking. And so people are deeply incentivized in the forking stage to report on the real outcome. So forks, again, are very disruptive on the platform, but the implicit factor that a fork can be invoked is what enables Augur to be efficient and effective. All reputation on all non-forking markets is unstaked. So say you have other markets that are currently going on, everything gets locked down, all reputation in the market now goes into this fork because the fork is so essential to ensuring the integrity of the Augur protocol that every other betting market shuts down. And so reputation that exists in the universe not corresponding to reality will be burned, and it's unlikely to earn owner fees, and so it holds no market value. Yeah, so quickly, I'll just ask if anyone has any questions on the fork, feel free to drop them. Otherwise, let's just move into settlement. We'll be touching a little bit more on forking later, as well as it's really a unique innovation to Augur within the DeFi prediction market space. Okay. Oh, let me go back. Pull this question. So it says likely hold no market value because at the point when you're staking on the child, so Sayana asked, why is it that reputation staking universe not corresponding to reality wouldn't hold market value? And why does it say likely not hold market value? It's because at the time when you're staking it, it still does hold market value, but as soon as the outcome is finalized, it loses all market value. So essentially at the point, there's no point in staking in a child universe that doesn't correspond to reality. So yeah, we'll now move into settlement. So traders get their rewards, and I touched on this earlier, by providing a share of the winning outcome and settling with the market contract. So all this is decentralized and ensures that there's no corruption or risk on the trader side and settling with the market contract. The fees are reduced from traditional centralized markets, and this is really what's incentivizing users and traders and bettors to move over to the Augur platform. So whenever you settle with the market contract, there's a creator fee and a reporting fee. The creator fee is paid to the market creator, and this is set before the market is created. Market creators are incentivized to set their fees as low as possible because people will then be more likely to bet on their market. The reporting fee is to pay the reporters who are then incentivized by this reporting fee to report the real world outcome. And these fees in general are much lower than what we see in traditional centralized markets. If there's no fork in the market, all staked reputation on other outcomes than the real world outcome is forfeited. So you have no incentive to stake on outcomes that are not, in fact, the real world outcome. So 20% of the forfeited stake is burned, and then the rest is distributed to users who staked on the market's final outcome. Then the reporters are given a 40% ROI on the dispute stake whenever they dispute a false tentative outcome. And so this really incentivizes users, reporters to call out, say like a designated reporter reporting an incorrect outcome for their own benefit. And this is really what drives the platform's efficacy. Yeah, so now we're moving into specifically the forking protocol, because this is, I was like reading an article about Augur, and it's like pretty easy to set up like the prediction market side, but setting up the decentralized oracle, especially with the forking protocol, is what enables the integrity of the Augur protocol. So we'll be diving a little bit deeper into how exactly the forking protocol works. So the forking protocol is necessary as a disincentive to attackers with malicious intent towards the Augur protocol. So any attacker who successfully attacks the oracle would cause all funds to migrate to a false universe, and so they would be able to capture all escrowed funds. So there's a deep incentive and a significant incentive for Augur protocol to create a platform that's able to handle attackers and stay resilient against attackers whenever they're going against the system. So an attacker's maximum benefit is the interest on the parasitic market, which is essentially a market that would be copying the outcomes from Augur's decentralized oracle without actually paying the fees that are necessary, and Augur's native open interest. And the open interest is what we see as the interest on the reputation token. And this is what corresponds to the market cap of Augur. So the minimum cost of an oracle attack is the price of the reputation migrated to a false universe. And so if the price of the true universe is less than the price of the false universe, so like the incentive is less than how much it would cost you to migrate all of your reputation to a false universe, and it's not economical for regular users to go after a false universe. So yeah. So forking integrity really comes into play. Wait, anyway, a quick question. Which percentages are you specifically referring to? Oh yeah, so I'll touch on the reporting fee later, but essentially the reporting fee starts at yeah, so the reporting fee is set at a specific rate, but then as the market shifts, so say like the market cap is, I'll touch on this a little bit later too, and I'll dive into this a little bit later, but essentially the reporting fee changes as the market cap corresponds to the amount of reputation staked on the platform. And this is what enables a dynamic market, because it wouldn't make sense that the reporting fee stayed constant whenever the market cap shifts in correspondence to the amount of reputation that's staked. So yeah, I'll dive a little bit deeper into the governance and the specific numbers on the percentages for the payouts and the reporting fees, as well as in the trading fees a little bit later on. So the integrity of the forking protocol really derives from this central assumption, the fact that reporters that are not attackers will never migrate reputation to a false universe during a market fork, because if you do that and it fails, you lose all of your reputation. So reporters who are honest are disincentivized to move to a false universe, which is a outcome that doesn't correspond to the real world outcome. So essentially what needs to happen, and this is fairly simple, is that more reputation needs to be migrated to a false universe than the true universe for a successful attack to occur. So the oracle will resolve to the objective reality if the maximum benefit to the attacker is less than the minimum cost of the attack. So essentially what that means is that no one's going to be paying more money than they'd be earning by attacking the platform. And this really derives from the central formula, which I'll touch on in the next slide, which is the integrity property. And it essentially states that people are disincentivized to attack the platform when they hold more than half of the tokens on the platform, as their gains would be less than the tokens that they actually have should they get burned. And this also will touch on the Sybil attack on the platform. So, get some water real quick. So the market cap security theorem dives into how exactly the forking protocol has integrity on the platform. And this really comes if and only if more than half of the reputation is migrated to the true universe during a fork, and that the price to migrate to a false universe is less than the price of the true universe, and the market cap of the reputation is greater than this arbitrary formula here, which refers to the interest on the platform, as well as the price of the platform when we're corresponding to the true universe versus the false universe. So when we're establishing this theorem, what we're assuming is that parasitic open interest, which is essentially the amount of interest that's being earned by the reputation token, and in general, like wherever the token is listed, like however it's being transferred, can be as large as 50%. And it really establishes this central conclusion that the forking protocol holds its integrity whenever the market cap of reputation is at least 3 times whatever the native open interest on the platform is. So the native open interest is how much interest the reputation token is accruing. So when we take a look at, so the parasitic interest of the forking protocol really comes from how the market cap is set up. And so what we see is that this is where we see the answer to, actually I'll touch on that later. But yeah, so essentially whenever the forking protocol has 3 times the native open interest, whenever the market cap of reputation is 3 times the open interest, that's when we see integrity in the forking protocol. And what we see is that Augur drives this towards at least 5 times to provide a buffer on the platform. So they adjust the native open interest either by buying or selling reputation, lowering the reporting fees and the prices in accordance to maintain that 5 times, to maintain integrity on the forking protocol, as the possibility of a fork is what disincentivizes attackers on the platform. So market participation, where we really see this come up is whenever parasitic markets that resolve in accordance with Augur market, but do not pay reporting fees, is where we see an impact on the forking protocol. Because what happens is that whenever so say like Augur has this oracle, right? And someone else makes another platform, but people are able to bet on the platform, do the prediction market without having to pay the consensus fees, which are essentially the reporting fees, as well as the creator fees on the platform. What happens is that the price of reputation is driven down, which drives down the market cap, which then puts the integrity of the Augur protocol into question, because it's driving down the price of the reputation token, lowering the market cap, which then makes the forking protocol loses its integrity. So the integrity of the Augur protocol, and this is really what we see as a common theme throughout the white paper, is that it relies on the users to act rationally on the platform and act in their self-interest by migrating to a true universe during our fork. So only attackers are people who are migrating towards a false universe. Whenever you're migrating reputation during the forking period, it's exposing the user to risk. And this is where we see the transition in risk away from the centralized Augur platform towards the bettors on the platform, the reporters on the platform. As by staking their reputation on the outcomes, they're really pushing people towards ensuring that they're being honest in the platform and ensuring that whenever that they do stake on the platform, that they're sure that that's the actual outcome. Additionally, when we take a look at the open market, the volatility of the reputation token, again, will play a significant role in how exactly the market will resolve, because we see this whenever like Ethereum had like its major swings. There was like the big, there was that day in March when MakerDAO crashed because everything on the platform got super clogged because of the significant drop in Ethereum. If there was a significant drop in reputation, what we see is that the reputation platform would be getting clogged because people would be incentivized to attack the protocol at that time. And so by maintaining a ratio that's higher than what's actually necessary to maintain the integrity of the forking protocol, Augur is able to ensure that its forking protocol stays secure and stays resilient. So lastly, we'll be touching on the oracles on the platform. And what we see is that market creators are really incentivized to choose a source that's consistent, that's clear, that holds a completely clear outcome. Because if this is the case, then reporters are able to report on the clear outcome. But should there be an inconsistent source, reporters and honest reporters need to coordinate to ensure that the market's resolved as invalid. And this is really what we see whenever there's, say, like you put up like the Schrodinger's cat as like a prediction market, right? It's an ambiguous market, like there's no clear resolution to it. And so what would happen is that it's necessary to ensure that all reporters finalize the market as invalid, or the market finalizes as invalid, as then all the fees are returned to all the bettors and all the reporters are given the actual outcome, because it disincentivizes corruption within the system then. Because if there's an unclear outcome, then people are acting with less information than the actual decision maker, and this is where we see the need for a decentralized protocol. Another kind of attack on the system is self-referential Oracle queries. So if you're asking if any designated reporter will report on the platform within the next 3 days, then all reporters on the platform who are designated reporters are incentivized to bet no. But then if one bets yes, then there's a conflict of interest, it destroys the protocol. And so this is where we see a need to finalize the system as invalid. And this is where Augur's unique innovation to do that comes in. It's providing 3 specific outcomes: yes, no, and invalid. And this is what we see in, it's expanding upon traditional binary options by providing that. And it ensures that the protocol remains integral when there are cases of ambiguous markets. So yeah, let's see. Yeah, so I have some notes that I'll open up on the specific rates, but basically for the percentages, what we see is that the reporting fee on the platform swings between, I believe it's 1% and actually let me just pull this up before I dive into the conclusions. And that's okay, but yeah, basically what happens is that the on the protocol, what we see is that the reporting fees swing with the market cap, and it ensures that reporters are incentivized to report in a way that ensures the integrity of the platform. Basically, whenever the market cap gets too high or there's swings in the platform, reporting fees get higher, as it's necessary then to ensure that there is clear outcomes on the platform. So yeah, we'll now be wrapping up, and this is where we're gonna take a look at the exact benefits of the Augur protocol, as well as expansions that we're seeing in V2 as well as in the future. So the Augur protocol really maintains a significant advantage in comparison to other protocols in terms of its security. The integrity of the forking protocol really drives users towards rational behavior. It ensures that users are incentivized to report outcomes that are aligning with those that we see in the real world. And it ensures that whenever those outcomes are reported, in the vast majority of cases, they align with what we see in centralized betting markets. But then whenever there are attackers on the system, it's able to be handled by the forking protocol or the threat of the forking protocol. For access, there's the ability to bet on more markets, whenever Augur came out, and these markets aren't traditionally allowed in traditional betting markets, but there was an interesting article about how exactly there were like essentially death markets, like people betting on like when a person would die, and this openness of the protocol, though it can have negative ramifications upon society, it does show that the protocol is able to align with the interests of the users, and then the users act rationally to maintain that alignment. They want to ensure that they're able to earn fees on it. They want to make sure that their bets are being placed through and that they're being resolved correctly, and this is where we see the benefit of the Augur protocol. However, when we take a look at where the Augur protocol could be improved, the implicit bias of placing a source that could be incorrect. So say that I place a source for, we'll say that what is, like the question was, what is Ratan's favorite ice cream flavor, right? And I directed people towards like my website, and I was like, oh, on this website, you'll be able to find what my favorite ice cream flavor is. So then during the first phase, whenever I put it down, I mark myself as the designated reporter, or someone that I trust as the designated reporter. And I tell them that, oh, my favorite ice cream is vanilla, but then on my website, I put it as chocolate, right? So when the designated reporter reports, they report vanilla, but then everyone disputes that. All the reporters who have rep dispute that on the platform because of like, oh, but on your website, it says that you actually like chocolate. So then when we move into the dispute round, I go into my website and I change that to say that I change it from chocolate to vanilla on my website. Now it says that I like vanilla, and this is what I said the whole time. But then everyone who had originally staked their reputation on the fact that I like chocolate is now going to be incorrect because I've now changed the objective truth. And this is where we see issues with the Augur protocol. It's the fact that the reliance on sources that may be ambiguous, sources that may be manipulated, is where we see issues with where the objective truth really is. And that's where there could be room for improvement on Augur. It's ensuring that those kinds of ambiguous sources that take advantage of bettors on the platform and reporters on the platform can actually be implemented into the platform. Additionally, the Augur protocol relies on all reporters being incentivized to participate in the forking process. And this is really accomplished to the fact that if you don't move or migrate your reputation during a fork into a child universe, you're going to lose all of it. And so as a result, we really see the need for maybe possibly a way to incentivize reporters to participate in the forking process earlier on, or to ensure that it doesn't actually happen. But with that, when it actually happens, all reporters are incentivized to participate in it to maintain the integrity of the platform. So let me, yeah, that market's really pretty interesting. So yeah, that's pretty much it. So yeah, thank you. If you guys have any questions, just feel free to ask them. Like, you don't have to ask them via chat, but like, yeah. Thank you.
Good stuff. Do you know how Augur, like version 2.0 improves upon the original?
Actually, let me pull it up real quick. One of my friends sent me an article about it. Nice. But yeah, basically it's the fact that like there's basically no one on the platform right now. Like it's very, very low in terms of its actual usage. And so they're kind of hopping on this like DeFi hype wave that's going on right now. And so they are so the white paper that I shared was the V2 white paper, but it's not completely finished yet. I believe essentially they're integrating is the invalid market, because a lot of people ran into issues with like, oh, like this market is ambiguous, like the result could be ambiguous, and so the implementation of an invalid market would ensure that the protocol is actually resolving in cases where the outcome isn't as clear to all the users. Let me link the V2 article. But yeah, there's also other prediction markets in DeFi. But the reason why I chose Augur is because they don't use like decentralized oracles. Like it's pretty much just they're relying on centralized sources of information. And it's not like crowdsourced. It's like not what we see on Augur, and so it's not as effective in terms of actually decentralizing what we see as like a centralized source of authority in traditional centralized betting markets. So, oh yeah, they're moving from ETH for all trading to MCD. So it's opening up in terms of like who can use it. So yeah, yes sir. Yeah, I think there's been a lot of transitions away from just plain Ethereum, but I think when V2 comes up too, the network will also be a lot faster in terms of like micro trading. And this is what we see in traditional like prediction markets too. It's like where the big money is made. Right now, it's the fact that Ethereum is having trouble keeping up with like the micro trading in the business. And once those transactions are occurring faster, then it'll be more effective. So yeah, so like I was looking at a Gnosis as well, but then Gnosis is kind of more like a like an SDK. I think it's like infrastructure for building prediction markets. So it's like you could build like a competitor to Augur from the Gnosis SDK. So they actually released something called Olympia. I'll link that in the chat. So, but it's basically like a it's like an Augur ripoff, but without the Oracle. So like it's not as effective. But like no shade towards Olympia, but like it's just yeah. Yeah, actually let me check that real quick. It's like a decentralized bookie from what they say. So it's essentially like a decentralized order book, but I don't think they have their reporting process is as Gnosis reporting. Yeah, so they don't have the as strong of a gnosis. No, gnosis. Okay, I'll stop shading them like that. But but yeah, so gnosis. Okay, so yeah, so they don't have like the reporting process, and it's not as strong as what we see on the Augur platform. I think I mean, they might use Chainlink, but like I don't think like when it kind of it was very surprising to me when in the white paper like Augur said that they were the first decentralized oracle, but then considering that all their information is like completely crowdsourced, it makes sense why they'd consider themselves like a truly decentralized oracle. No, what do you mean by like a security token exchange? Like just like a like Uniswap, or like do you mean like a way for like how would I guess you could be trading on I'm not sure how powerful their SDK is, Andrew, on whether or not you could build like a normal security token exchange on Augur. But yeah, I'd assume it wouldn't be as effective as what you'd see on like Uniswap protocol. It wouldn't be as effective because of the reporting fee that's involved, so it wouldn't be as market efficient. You could bet on that as well. Yeah, price changes. I guess you could like short stocks too. Like you'd be like, oh, like this stock's gonna hit this amount, and then people would trade on the outcomes for that. And like that's where you see the instantiation of like a derivative market. So it would be like that. It's just adding layers to how exactly you interact with. Yeah, that can be accomplished on Augur. Yeah, that's fair. Yeah, I just think that in comparison to more streamlined protocols, Augur is not as effective at being like a high frequency trading platform. Yeah, it'd be better to trade where you had more leverage. And so platforms like synthetics would be better to trade whenever you're considering high frequency trading, just because like your margin calls, like you can't do a margin call on Augur, like you can't get leverage on Augur. So it's not as effective, but then it's more effective in terms of, oh, like betting on the Super Bowl because or actually it'd be more effective like where they step in is like bookies take a lot of money away from people who are betting, and this is where we see the incentive for Augur to come in. Yeah, pretty much. Yeah, leverage is pretty insane too. Like dydx is like 10 times now, so that blew my mind too. So, yeah. Let me see if there's anything else I want to touch on in my notes. Yeah, I think that's pretty much it. Also, after the forking protocol is finalized, like that's like the final outcome. So there can be like back-to-back or like consecutive forks, because that would kind of make the protocol very, very ineffective because people could just challenge the forks. So forks are considered the final outcome on the platform, whereas dispute rounds can be continually challenged and disputed until they reach a final outcome. So, yeah, if you guys have any more questions, let me know or like text me after if they come up. But yeah, I think that's pretty much it on my side.
Thanks, Ratan. Wait, what is it? Is it Ratan?
Yeah, it's Ratan. Wait, you said
Okay,
it
okay.
right. You said it right.
Okay. I was
Yeah.
like, I always hesitate every time I'm about to say your name.
Dude, my 7th grade like history teacher used to not be able to say my name, so he just called me Ratatouille for like a whole year.
That's cute though.
It's a great time.
Wait, should I stop the recording for this?
Yeah, if the questions are pretty much wrapped up, I think.